Every financial tip for people living in America explained. Create a detailed budget. A solid budget is the foundation of any good financial plan. It helps you understand where your money is going and where you can save. Start by listing all your sources of income, including your salary, side hustles, or any passive income streams. Next, break down your expenses into fixed costs like rent, utilities, and insurance, and variable expenses like groceries, entertainment, and dining out. Track your spending over a few months to get a clear picture of where your money is going, and look for areas where you can cut back. A well-planned budget not only ensures that you cover your necessary expenses, but also allows you to allocate funds towards savings, investments, and debt repayment. Build a strong emergency fund. Life is unpredictable, and unexpected expenses can pop up at any time. Whether it's a medical emergency, car repair, or job loss, an emergency fund can help you navigate these challenges without going into debt. Financial experts recommend saving 3 to 6 months worth of living expenses in an easily accessible account, like a savings account. While that might seem like a lot, start small. Aim to save $500, then $1,000, and build from there. The key is to make regular contributions to your emergency fund, treating it like any other necessary expense. Pay off high-interest debts. Debt can be a significant burden on your finances, especially high-interest debts like credit cards or payday loans. These debts accumulate interest rapidly, making it harder to pay them off over time. To tackle your debt efficiently, focus on paying off the ones with the highest interest rates first, while continuing to make minimum payments on the others. This strategy, known as the avalanche method, helps reduce the amount of interest you'll pay in the long run. Alternatively, some people prefer the snowball method, where you start by paying off the smallest debts first for a psychological boost. Automate your savings. One of the easiest ways to ensure you're saving consistently is to automate the process. Set up automatic transfers from your checking account to your savings or investment accounts each time you get paid. This pay-yourself-first approach ensures that you prioritize saving before spending money on non-essentials. You can also automate contributions to specific savings goals, such as an emergency fund, a vacation, or a down payment on a house. Start investing early and consistently. Time is one of the most valuable assets when it comes to investing. The earlier you start investing, the more time your money has to grow through the power of compound interest. Even if you can only contribute small amounts at first, the key is to be consistent. Set up a regular schedule for investing in your retirement accounts, such as a 401k or IRA, and aim to increase your contributions over time. You can also invest in stocks, bonds, or mutual funds to diversify your portfolio. Diversify your investment portfolio. Putting all your money into one type of investment can be risky, especially if that market experiences a downturn. Diversification helps spread your risk by investing in different asset classes, such as stocks, bonds, real estate, and even commodities like gold. This way, if one investment performs poorly, others in your portfolio may still perform well, balancing out your overall returns. Diversifying within each asset class is also important. For example, when investing in stocks, consider spreading your money across different industries and companies. Limit unnecessary spending. We all have spending habits that can add up over time without us realizing it. Whether it's buying coffee every morning, ordering takeout, or subscribing to multiple streaming services, these small expenses can take a significant chunk out of your budget. Review your discretionary spending and look for areas where you can cut back. This doesn't mean you have to stop treating yourself, but being mindful of where your money is going can help you save more. Maximize employer benefits. Many employers offer benefits that can help you save money, such as 401k, matching, health savings accounts, HSAs, and flexible spending accounts, FSAs. Take full advantage of these benefits if they're available to you. For example, if your employer offers a 401k match, contribute enough to get the full match. This is essentially free money for your retirement. HSAs and FSAs can help you save on healthcare costs by allowing you to use pre-tax dollars for eligible expenses. Maintain a good credit score. Your credit score is one of the most important factors when it comes to borrowing money for large purchases like a car or a home. A good credit score can help you qualify for better interest rates and save you thousands of dollars in interest over the life of a loan. To maintain a strong credit score, pay your bills on time, keep your credit utilization low, below 30% of your credit limit, and avoid opening too many new credit accounts at once. Live below your means. One of the most effective ways to build wealth is to spend less than you earn. This means living within your means and avoiding lifestyle inflation, the tendency to increase spending as your income grows. By maintaining a frugal lifestyle, you can save and invest more money, which will help you achieve your long-term financial goals faster. Living below your means doesn't mean you have to deprive yourself of the things you enjoy, but it does require being mindful of your spending habits and making smart financial choices. Set long-term financial goals. Setting clear financial goals gives you something to work toward and helps you stay motivated. Whether your goal is to buy a house, retire early, or travel the world, having a plan in place makes it easier to achieve those dreams. Break down your long-term goals into smaller, more manageable steps, and set specific deadlines for each one. For example, if you want to save $50,000 for a down payment on a house in 5 years, determine how much you need to save each month to reach that goal. Plan for major expenses. Whether it's a wedding, a new car, or a home renovation, major expenses can put a strain on your finances if you're not prepared. Planning for these costs in advance can help you avoid going into debt or dipping into your emergency fund. Start by estimating the total cost of the expense and setting a savings goal. Open a separate savings account dedicated to this goal and contribute to it regularly. By planning ahead and saving gradually, you'll be able to cover major expenses without derailing your financial plan. Get adequate insurance coverage. Insurance is a crucial part of any financial plan because it protects you from unexpected expenses that could otherwise drain your savings. Make sure you have adequate coverage for health, auto, home, and life insurance. Additionally, consider disability insurance and long-term care insurance if they're relevant to your situation. Shop around for the best rates and review your policies annually to ensure they still meet your needs. Having the right insurance coverage can provide peace of mind and prevent financial setbacks in case of an emergency. Save for retirement early. Retirement might seem far off, but the earlier you start saving, the more time your money has to grow. Take advantage of tax-advantaged retirement accounts like 401ks and IRAs and contribute as much as you can each year. If your employer offers a 401k match, be sure to contribute enough to get the full match. It's essentially free money. Even small contributions can grow significantly over time thanks to compound interest. Take advantage of tax-advantaged accounts. Tax-advantaged accounts like 401ks, IRAs, HSAs, and FSAs offer valuable tax benefits that can help you save more money. Contributions to these accounts are often tax-deductible or made with pre-tax dollars, which reduces your taxable income. Over time, the tax savings can add up, allowing your money to grow faster. Make the most of these accounts by contributing as much as you can each year, and take advantage of employer contributions or matches when available. Avoid impulse buying. Impulse purchases can add up quickly and throw your budget off track. To avoid making impulsive decisions, create a rule to wait at least 24 hours before buying anything that isn't part of your budget. This gives you time to think about whether the purchase is necessary or if it's something you can live without. Many times you'll find that the urge to buy fades after a day or two. Practicing mindful spending helps you stay focused on your financial goals and prevents you from accumulating unnecessary debt. Review your financial situation regularly. Your financial situation can change over time, so it's important to review it regularly. Set aside time each month or quarter to go over your budget, savings, and investments. Check in on your progress toward financial goals and make adjustments if needed. For example, if your income increases, consider increasing your savings rate or paying down more debt. Regular reviews help you stay organized and ensure that you're on track to meet your financial objectives. Seek professional financial help when needed. Managing your finances can be overwhelming, especially if you have multiple financial goals or complex financial situations. In such cases, it's a good idea to consult with a certified financial planner, CFP, or financial advisor. They can help you create a comprehensive financial plan, offer investment advice, and provide guidance on retirement planning, tax strategies, and other important financial decisions. While there may be a cost involved in hiring an advisor, the value they provide in helping you grow and protect your wealth can outweigh the expense.